Good morning, everyone. I'm Saluja from AAT Sri Lanka. You all are warmly welcome to today's session. Today, our topic is Internet Control Systems and Business Processes for the students, those who are following stage 3. For the today's session, we invited one of the famous lecturers, Mr. Taranga Madurapeli. He's a member of AAT Sri Lanka and also a member of Sri Lanka, and also he's having a degree in accountancy. So, Mr. Taranga, you are warmly welcome and also kindly invite to start session. Session is over to you, Taranga.
Thank you, Saluja, and good morning to all of my students. So today we'll be starting the third chapter, the topic of your subject, financial controls and auditing. So the topic is internal controls and business processes. So like I explained last 2 weeks, during last 2 sessions, I explained to you that what we discussed so far is the background of a business organization. And from this week onward, we are starting the technical sessions of business processes and the auditing concepts. So today we'll be officially starting business processes and internal controls. So therefore, I'll be taking, I'll be completing only the internal controls side of the chapter today, and next week it will be the business processes. So as I explained in the first week, the agency conflict, the agency theory is an important part from today's session onward, and I'll be explaining once again the agency conflict, and I'll get it. I'll use it as a starting point of this entire concepts of auditing, business processes, and internal control. So let me go to the slides, and we'll start the session officially. Right. Right. So as you can see, so we are in the third chapter, internal control system and business processes. So this is the detailed content of the chapter. There are actually two parts, the internal control systems and the business processes. So business processes includes 5 detailed business processes called procurement, payroll, cash management, inventory, property, plant and equipment. So those processes will be discussed during the next week. So today's I'll be completely cover the areas coming under the internal control system. So you can see this, the 4 boxes appeared in the top of the slide: internal control system of the organization, types of internal controls, components of internal control system, and importance and limitation of internal controls. So let me go to the session internal control systems. Before moving there, so I need to get a proper starting to the subject, to the entire concepts of auditing, and where this concept of internal control and business processes fit in the concepts of auditing. So let me go back to our first session. I think most of you who joined with us in the first session may remember the slide, this picture. So I'll be explaining once again, taking some detailed time to explain it. So can you remember the example I took in the very first session, that is to describe the agency conflict, that suppose, just assume that you are residing in Australia, you have a coconut land in Sri Lanka, so there's no one to look after, so you appoint an agent in Sri Lanka to look after your coconut land, and that agent is supposed to have a good care of your coconut land, as well as remit whatever the income he's generating from the coconut land to you, and for that you will be paying him a salary. So you are residing in Australia, and the coconut land is in Sri Lanka with the agent, and after some time, obviously there will be a conflict between you two, because you can't see what's happening in the business, in the coconut land, what's the agent's doing, whether you are having doubts whether the agent is acting on behalf of you, right? So the agents also tend to think that, okay, so that the owner of the coconut land is not coming to Sri Lanka, so there is a tendency to get some personal benefit from the coconut land. right? So this conflict, the principal who is residing in Australia and the agent who is residing in Sri Lanka, the conflict, this credibility issue happening between the principal and the agent is what we call the agency conflict. So if you really apply that example to a business organization, formal business organization, that's happening in a business organization as well. Shareholders are the owners of the business organization. They have invested some amount of money in a business organization, acting the role of the residing principal in Australia, right? So at the same time, you know that there are maybe 2,000, 3,000 shareholders in the company. Like all these 2,300, 3,000 shareholders can't come to a boardroom and manage a company. So they will appoint a suitable set of people we call the board of directors or maybe the management to look after that business organization. Simply, the funds contributed by the shareholders will be managed by another set of people called board of directors. So the management simply acting the playing the role of that agent residing in Sri Lanka who's looking after that coconut land. Right, so you can see clearly in this picture, the shareholders have invested money in the company, and the board of directors or the management who are managing the invested company of the invested money in the company. So obviously, these two set of people, shareholders and the board of directors, are having a conflict, having some credibility issue, having some transparency issue. Right? The shareholders can't see all the things done by the board of directors. The board of directors may tend to get some personal advantages, personal benefits from the money invested by the shareholders. So this conflict is eternally happening, right? So as a solution only we discuss the corporate governance system which will guide and manage a business organization is what we call the corporate governance. So that's the structure to manage this agency conflict. So the first thing to ensure the transparency of all the transactions happening in the business organization is to prepare financial statement. That's the responsibility of the board of directors or the management, right? So as the first step, they will prepare their financial statements and submit it to the shareholders, saying, okay, this is what has happened to the money you have invested. This is your assets, liabilities, and this is your equity entitlement, and this is the income statement which shows the performance of your company. So simply they can prepare a set of financial statement and give it to the shareholders to increase the transparency. But preparation of financial statement is not sufficiently remove this agency conflict or remove this transparency issue or the credibility issue, right? Because the board of directors or the management can still mismanage the company and prepare financial statements and give it to the shareholders. So therefore, shareholders not necessarily believe in the numbers prepared by the management or the board of directors. So obviously, the third party, the independent third party come into the play. We call the auditor. Right? Auditor, he's come into the play, and the shareholders can request them, okay, have an independent look at the financial statements, and please give your opinion whether the financial statements are correct. Simply the word correct, but in when we are moving forward, you will realize the real technical jargons behind this auditing concept. We normally call it whether the financial statements are materially misstated. Then the auditor can give his opinion whether the financial statements are misstated or materially misstated or not. Then the shareholders can rely on the numbers prepared by the management. So this is the simple process, simple picture to mitigate or avoid the agency conflict, right? So now we'll link this entire picture with our today's topic, that is business processes and internal controls, and how these two topics are linked together. So this picture is very important, and moving forward next week onward. So before starting the session, I'll be quickly go through this picture again and again and again, because this is a very important picture you should keep in your mind when you are before you are sitting for your exams, right? Okay, now we'll come to the business process and internal controls and how it links with this picture. Now, I told you that the board of directors of the management is preparing financial statements, and the numbers prepared by them are audited or reviewed. Don't worry about the words. So we will properly learn those words, technical jargons in future. For the moment, those numbers prepared by board of directors or the management will be audited by the independent third party called auditor and give the opinion to the shareholders. Okay, financial statements are not materially misstated. Simply financial statements are correct. So you can rely on the numbers. That's the simple normal process. Just suppose, like just assume when auditor is coming to the company and auditing financial statement, he realized that financial statements are materially misstated. Financial statements are not free from material misstatements. Simply financial statements are incorrect, materially incorrect. So what is material? We will learn in future. Simply financial statements are incorrect. Right? So what will happen to the board of directors? Right? The financial statements prepared by the management is incorrect, and auditor is giving his opinion to the shareholders. Look, the financial statements are materially misstated, which is not correct. Simply your money has not been managed well, it's mismanaged, right? So what will happen to the board of directors? So simply they will be removed, right? So there will be so much of negative repercussions after that. So therefore, the board of directors and the management has a responsibility to make sure that financial statements are not materially misstated. Simply, they have to ensure that financial statements are prepared accurately. Financial statements are prepared accurately. To prepare something accurately, first of all, they need to understand where it can went wrong. Simply, what are the factors which will um, which will be like making the financial statement incorrect, right? So in a business organization, simply the financial statements can be incorrect because of two reasons, and you can see those two reasons in the slide clearly. That is the errors and uh, frauds, right? So error is something unintentional, right? Fraud means something intentional, some mistake done intentionally. We call it as a fraud, or something intentional, it's an error. So in order to prepare financial statement accurately, so what you should avoid now, you should avoid errors and you should avoid frauds. If you can avoid errors and frauds, if you can ensure that the financial statement doesn't include any errors or the frauds, the financial statements are free from material misstatements. Simply financial statements are materially correct. Right? So how you can avoid errors or how you can avoid frauds in a business organization? Simply by having a good business process. Right? So having a good business process is not sufficient. Right? Having a business process alone is not sufficient at all. Therefore, you need to make sure that relevant internal controls also established in the business organization to make sure the business processes run smoothly. So now you can clearly understand this picture. So once again, I'll quickly go through what's appearing in this slide, right, which is a very important slide, which should be in your head in the future, because the entire picture behind this subject is appearing in this slide. So shareholders, once again, the shareholders have invested money in the company. That money is managed by a different set of people called board of directors or management, right? So in order to increase the transparency between these two parties, in order to avoid the agency conflict, the board of directors are preparing financial statement, but the shareholders no need to believe in the numbers prepared by them as they prepare. Therefore, they can request an independent third party called auditor to come into the picture and review our financial statement, give their independent opinion whether the financial statements are correct. Right? So there are so much of negative repercussions if the financial statements are incorrect, materially misstated. So therefore, the board of directors or management have a huge responsibility to make sure that financial statements are free from material misstatement. So therefore, they need to understand why a set of financial statement can be materially misstated. There are two reasons: because of error or because of a fraud. Error is something unintentional and fraud is something intentional. So whatever, whether it's intentional or unintentional, if there's something wrong in the financial statement, it's materially misstated. So in order to come to that level, the management should make sure that a proper business processes should be there in the business organization, and that process alone is not sufficient, right? Like if you take some business organization, the business processes are there, well written, but people don't follow. So what will happen? Again, the objective is not fulfilled. Therefore, not only the business processes, so the relevant internal controls also should be there. So I'll quickly explain one simple example. Let's say how error or a fraud can impact the financial statement, how internal control and a well-defined business process can avoid such error or frauds. Let's say in a business organization, let's say an employee need to buy a laptop computer, right? So there is no process to procure such fixed assets or normal purchases. There are no any processes. So what the company is doing, that particular employee is purchasing the laptop by his own money and then reimbursing later. So let's say the laptop computer is 150,000 and he is purchasing the laptop and giving a bill worth of 250,000, committing a fraud, right? So what will happen to the financial statement? The real value of the laptop is now 150,000, but in the financial statement it will be recorded as 250,000. And your financial statements are misstated. 150,000 worth of asset is appearing as 250,000. So which is a very immaterial or simple example, but just assume such transaction can happen with millions. So financial statements can be misstated very material. So how you can avoid that situation? By implementing a good process, good procurement process. If a company need to purchase a fixed asset or whatever the purchases, so they need to establish a good process to make sure that all the purchases are happening accurately. Let's say as an employee, I need to purchase a laptop computer, so I need to get the approval of my superior. Then there should be an independent procurement department separately in the business organization. So we make the request to the procurement department, so they will select the suitable suppliers, then getting quotation from different suppliers, compare prices, their qualities, and all the factors which will be discussed in very detail next week, and find the suitable supplier and get the laptop to the company. The fair price will be recorded in the financial statement, and we can make sure that there are no errors or frauds can happen with that process. And also that relevant controls is also should be there. Now let's say the process is there, the procurement process is there to purchase a laptop, but still people don't follow. They purchase their own laptops and claim the bills from the company. So that's why the internal control also should be there, that if we are purchasing a fixed asset, 3 minimum quotations should be obtained from the suppliers. That is the internal control. And internal auditor has to verify that whether each and every purchase of the company has the 3 quotations from the suppliers likewise. So business process alone is not sufficient. The internal control is also important. So today, I think now you are clear with the picture, and I think it's a successful starting point to the topic we are going to discuss today. So this business processes and internal controls is our third chapter, and from that I'll be discussing one part, that is the internal control today. With that, we'll move forward. Okay, so now what is internal control? Internal control is a simple act, right? A small process designed to make sure. Just read the slide, will you? What is internal controls? The process designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance about the achievement of an entity's objectives. With regard to, there are 3 objectives which I will explain later. right? So internal control means a small process, small act designed and implemented to achieve simply the organization goals. There are three goals which I will explain later, right? So simply internal control is an act you are establishing or implementing to make sure something is happen or not happen, right? In order to the ultimate objective is to prepare your financial statement accurate. So from your financial statement, the real picture, the true picture of the company is reflected. That's the ultimate objective. So in order to go there, right, so you are implementing a simple process, small act, piece of act, designing something like that in order to make sure that the relevant objective of the company will be achieved. So by reading this formal definition, before coming to the objectives, there are three objectives. Before coming to the objectives, you can identify two important points, which is what I am taking separately in these two big circles. The management is responsible for the design and implementation and maintenance of internal control, right? So if I go back to this slide, right, so clearly you can see that the auditor is a separate independent party. Now, most of the students tend to think that okay, this internal control is also a responsibility coming on the auditor, which is not. So this picture clearly explains you that the auditor's responsibility is to look at your financial statement and provide independent opinion whether the financial statements are materially misstated or not, or another technical word we are using, which we will learn in future, whether the financial statements are true and fair, right? So that's his objective, that's his responsibility, that's it. So the board of directors has the responsibility to make sure that the financial statements are not materially misstated. In order to achieve that status, they are the one who are responsible to have good, a solid business process and an internal control. So which is a very important point. The management is responsible for the design, implementation and maintenance of internal control, right? Then the second point is internal control system cannot guarantee that an organization will meet its objective. Instead, internal controls can only be expected to provide a reasonable assurance. That is also a very important word. We have a separate topic for that called assurance engagement, which we will discuss in very detail. But for the moment, it is not a absolute assurance. It's not 100% certification to say that this company doesn't have any frauds or error. It's not something like that. So there are so much of inherent limitation even in the internal control, even in the internal control system, right? Even in a well-controlled environment, there can be inherent limitations. As a result, you can't give 100% absolute certification to say that this particular company doesn't have any error or fraud. It's not like that, right? Still, there can be errors or frauds with the limitation. That's why it says it's a reasonable assurance. It's a reasonable assurance. So keep these 2 points very in your head, very, very important. Management is responsible, and it's just a reasonable assurance. It's not a perfect, absolute 100% certification to say that this company doesn't have any errors or frauds. It's not like that, right? Okay. After that, two important points, then we'll come to the last part of this definition. If you can just read the definition again. The process designed, implemented, and maintained by those charged with governance management, they are the one who are responsible to provide reasonable assurance, we discussed, about the achievement of an entity's objectives with regard to, so these are the objectives: reliability of financial reporting, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. So why we need to establish a good internal control system? There are three objectives, three reasons. What are those? Right? To have a reasonable financial reporting, have a good reliability on the financial reporting of the company, then efficient and effective and simply the smooth operations of the business organization, and compliance with several rules and regulations. So in order to achieve these three objectives only, we are having internal controls. Right? So we'll discuss these three objectives in very detail, very important. Right? The first one is the reliability of financial reporting. So simply, like the example I took, the laptop purchase, right? So in that case, what will happen to the financial reporting? Is it reliable? No, right? So 150,000 worth of laptop computer has been purchased in the company, but the financial statement says it's 250,000. Is it reliable set of financial statement? No, right? So obviously, so that's why we need to incur, like that's why we need to implement or establish an internal control to make sure your financial statements are reliable. If the asset value is 1 million, the fair value of the asset is 1 million, the financial statement should reflect the machine as 1 million. So that's what you meant by the reliability of financial reporting. So by implementing internal control, you can achieve that status, right? So it is the responsibility of management to prepare financial statement to meet the common use of most users. Therefore, financial statement need to be reliable. Exactly. So I think in the your financial accounting subjects also you may have learned these things. So there are two main reasons for why financial statements are prepared. First thing, of course, to address this agency conflict. Second reason is there are large number of stakeholders, right, common users who are using your financial statement to make economic decisions. Let's say your financial statements are not reliable, what will happen to the decision taken by them, right? So which is also probably can be a error, the decisions taken by them as well, a big error. So example, let's say the government is looking at your financial statements and taking economic decision, maybe to impose a new tax or new law, right? So what will happen if your financial statement doesn't give the true picture, right? So which is not the case, right? So the therefore, in order to achieve that reliable financial reporting system, you need to make sure that proper internal controls are implemented, right? Okay, we'll come to the second objective, the effectiveness and efficiency of operations. Now, if we take some incident like, let's say, breakup of a machine, right? So you are having a continuous smooth production process. Suddenly a machine uh, get broken. So what will happen to your process, and what will happen to the, like, as the end result, you will not be able to complete the process on time, the manufacturing process on time, and you can't deliver the product, and ultimately you will lose the customer, and maybe it's a question to your survival, right? So what will happen if you can implement the internal control? Like I explained, internal control is something to make sure that which is happen or not happen, right? Let's say you are having a checklist, a small checklist to make sure that, okay, every day before you are starting your switching on your machine, so you are starting your delivery van, like you have some set of checks to be checked, like whether the oil has been incurred, and whether the water levels are okay, whether the machine is working properly, some small test before you are starting the commercial production process, or whether you are starting your delivery van to start your deliveries, right? So this small act of checking all those things, that checklist can be considered as a good internal control to make sure that machine will not be broken when you are in the process, when you are in the middle of the process. So likewise, by implementing a good internal control, you can make sure that your operations are smoothly, simply, effectively, and efficiently flows, right? So controls with an organization are most meant to encourage efficient and effective use of resources, including personnel, to optimize the company's goals. An important part of these controls is accurate information for internal decision making. Another important part of effectiveness and efficiency is safeguarding assets and records, right? And the third objective is the compliance with applicable laws and regulations, right? Now let's say we'll say a tax payment, right? So normally, as per the Indian Revenue Department in Sri Lanka, so they have some timelines, right? So let's say their particular tax payment has to be supposed to be paid before or no before this particular date, right? If you fail to do so, there will be so much of negative repercussions like fines and some other penalties and all, right? So therefore you need to make sure that you are complying with the deadline, right? So in order to achieve that, you can implement a small internal control to make sure that you are achieving those compliances. Maybe again a simple checklist, whether you are done all the statutory reporting, so the statutory payment to the government authorities on time, so you can make sure that it will happen on time, right? So likewise, these are the three objectives. So keep in your mind, have a reliable financial reporting, have an efficient and effective operating process, and to comply with the applicable laws and regulations. So these are the three objectives of internal control. So with that, we'll move to the next important part, that is the types of internal controls, right? So one, simply there are two types of internal controls, which you, by using those types, you can classify the internal controls into mainly two areas, that is based on the objective and based on the behavior of the internal control. So based on the objective, now it's, you know that what are our objectives. It's the reliable financial statement, efficient operations, and the compliance requirement. So based on these three objectives, you can classify internal controls into three. Simply operational controls, financial controls, and compliance control. The checklist you are preparing, or maybe let's say the morning checkups of the machines and equipments, and maybe your delivery vans, can be recognized as operational control, right? So in the second one, financial control, maybe let's say a check. Normally in a business organization, most of the payments are paid by using a check. That check has to be signed two parties, two authority levels, right? Maybe the accountant is signing, and at the same time the chief financial officer, the CFO, is signing the check. Two signatures should be there. So that's the internal control to avoid some fraudulent payment. So that's a financial control. Like the compliance control is the simple checklist I told you, to comply with statutory payments, statutory reporting, right? To comply with the deadlines, you can have a simple checklist. Then the second broad classification is the behavior, right? So this is something we need to discuss in detail. There are three internal controls. Like simply you can divide the internal controls into three types by using their behaviors, that is the preventive controls, detective controls, and corrective controls. So by the meaning of the word, you can get an understanding. So what you mean by preventive control is preventive, before happening something, right? You can implement the internal control to make sure that before happening an error or fraud, right, to avoid that, to prevent that error or fraud, right? Simply let's say that two signatures in a check, right? That's a preventive control. Now before making the payment, the check or the payment is going to two authority level, right? If it misses by one person, there's another person to capture if there's an error or fraud inside this particular check payment, right? So that's a preventive control before something happens. Then the detective control is to after something already happened, right? So detective. So you are detecting whether what has happened there, right? So once the error or fraud happened, what has happened and who has done it, to identify those information, you can use a detective control. The best example is CCTV camera is a good detective control. So once the fraud is happened, the companies can use their CCTV cameras to find out what has happened there and who has done it. And the third one is corrective controls. That is, so something has already happened and you are inputting, you are implementing internal control not to happen it again, just to correct it, right? So the example is in most of these maybe let's say invoice system, payment systems, right? So all these systems are go with a unique number. Now let's say you are having a invoicing system, right? So that system is generating, like giving you an automatic number once you input the invoice number one. So it gives the number maybe 001, and when you are inputting the next invoice, it will goes as 002, right? Let's say mistakenly with a fraudulent intention or as an error, right? So you are entering an invoice once again. You are inputting the 001 again, and the system give you an error message. No, 001 is already entered. You can't enter it anymore. So that's a corrective control to which has been already happened, and you can't do it anymore, right? So those are the corrective controls. So then we will discuss a little bit in detail these 6 types of internal controls with few examples. So now you can easily identify what are the types of internal controls. There are 2 broad classification based on the objective and based on the behavior. Based on the objective, you can classify as operational controls, financial controls, and compliance controls. Based on the behavior, it's preventive controls, detective controls, corrective controls. Actually, if you really look at this acts as a matrix, which I will explain later in a future slide. You can see that. So let me go to that slide. Yeah, here. So actually, there are now 9 controls, right? With these 2 broad classifications, there can be 9 internal controls in a business organization. Simply preventive financial controls, detective financial control, corrective financial controls. Likewise, preventive operational controls, detective operational controls. Likewise, the matrix goes on. There are 9 controls with the example I will discuss a little bit later. Right? Okay, so quickly I'll go through these types of internal controls. First one is the operational controls, right? Simply to make sure a smooth operations are happening in the business organizations. So look at the examples. First one is regular breakdown in machinery due to inadequate maintenance. So in order to avoid that risk, what is the internal control you can implement? Maintain machinery according to the instruction given user manuals, right? So if you are using the machine according to that, there will not be any unexpected damages unless there is an inherited issue with the machine or not. Okay, so the second one is theft of inventories. The control is implement physical safeguards such as access controls in stores, right? Only the authorized parties can go to the stores with the unique ID or some biometrics access controls, the thumbprint. And also by using those internal controls, you can make sure not ensure 100%, but up to a certain level. So the possibility of having a theft in the stores inventories, you can reduce at a certain level. The third one, unauthorized access for a factory building. Security guards, CCTV cameras can be occupied in the entrance and the factory premises. So these are simple examples of operational controls. We'll move to the second one, that is a financial controls, simply to make sure that you are having a reliable financial statements. You are having these internal controls. Few examples: failure to document all the invoices, right? Control is all the invoices must be recorded according to serial number, right? A simple act, right? But it will avoid so much of errors and frauds. So the second one is making payment for goods not received. That's the reason, right? From maybe fraudulent or maybe erroneous, right? Payment voucher should be supported with purchase order, GRN, and other external supporting documents. So what is this GRN, purchase orders, and we will discuss in very detail in the next chapter, that is our business processes, which is coming under procurement process. So before moving forward, I'll tell you on one other important point. So in your exam context, it's very rare you get a question like a 5-mark question from the theory, this internal control. Like there are instances, 1 or 2 exam papers are having, let's say, 2 to 5-mark questions coming from this internal control system. Is very rare, right? So in addition to that, in the part C of your question paper, you will get 2 questions, 25 marks each, some case study type questions. So most of the time, these internal controls and business and processes are tested in a one big 25-mark question, right? So that's why. So I'll go to the exam focus after discussing tomorrow next week's session as well, because the questions are coming maybe like together with the like financial controls and business processes together, only you are getting this case study type questions, which I will discuss in detail. So that's why don't worry about these words, payment voucher, but the purchase order, GRN means good receive notes, right? So there are set of documents we need to discuss in the next session, right? So once you realize, once we studied the next week's session and combine it with today's session, so you can successfully answer questions, right? Okay. Then the third example is excessive staff claims than the entitlement. Let's say a staff is entitlement for, let's say, 500 rupee traveling, right? So he's claiming 600 rupee with the fraudulent intention, right? So how you can avoid such fraudulent activity by implementing internal control. So approval for the staff claim should be mandatory to perform the payment. So that particular employee staff claim should be approved by his superior, right? So simple act, but can avoid a large number of frauds and errors. Finally, the compliance record, as I told you, there are so much of compliance requirement coming with the relevant industry. Let's say you are working in the hotel industry, right? So there can be set of government authorities, right, attached with the company. So there can be so much of statutory payments, then statutory reporting requirements. Let's say you are in the banking industry, right? There are so much of statutory reporting and statutory requirements with the central bank and all, right? So you need to make sure that all those guidelines, regulations are complied on time, right? So therefore, you have to implement a set of internal controls to make sure that all those timelines are achieved with the statutory reporting and the statutory payment. So simple checklist can be an internal control, right? Okay, so with that, we'll come to the second set of internal controls, that is based on behavior. First one is preventive. I explain you before something happened, before the error or the fraud happened, you can implement some internal controls to avoid such errors or frauds. We'll discuss few examples to prevent payments to suppliers for goods that have not been received, right? So you are making a or erroneously or with the fraudulent intention, you are making an additional payment to the supplier for something you haven't received in return from the supplier, right? So you can implement this control, checking invoices received the supplier against a good receive note showing details for actually what you have received, right? Simply, I'll quickly explain this example. When you are purchasing something as a formal business organization, you can't just go to the shop and purchase something, right? So you need to, first of all, you need to prepare a purchase order with the proper approval. This is what we require, and you are sending the purchase order to the supplier. Then once supplier is deliver the goods, that particular person, maybe the storekeeper or the procurement manager, he has to prepare a document called good receive note, GRA. We received these goods. This is what we ordered and this is what we received. And finally, when you are making the payment to the supplier, you need to cross-check the supplier invoice with purchase order as well as good receive note, whether we are paying for what we ordered and what we received, right? So both the documents are important. Don't worry, I will explain in very detail in next week, because now something you may have received the goods, but which is not ordered by you. That's also maybe error or fraud. Understand? So you are ordering only 1,000 units and you are receiving 10,000 units and you are paying for 10,000 units. That's why comparing the invoice and good receive note is also not sufficient. It should be cross-checked with the purchase order. If you have ordered 10,000 and if you have received 10,000, then you can pay for 10,000. Simply like that. So that's a good internal control, which we will discuss in very detail in next week. Right. Then the second one, to prevent time wasting or inefficient working by employees. So supervision of employees at work. So you may have seen most of the garment factories, most of the manufacturing process-oriented business organization. People are doing a small piece of work of the entire process, and one single person is allocated to supervise them, whether they are working properly, maybe to check the quality, maybe, but sometimes whether they are having some idle time with the process, right? In order to make sure that's not happening, In order to prevent such idle situations, you are appointing one supervisor to maybe to the one row of the factory, right? So that's a good preventive control. Finally, to prevent excessive payment to casual staff, attendance sheet should be cross-checked with the payroll before processing the payment. Sometimes in a business organization, so there can be two types of staff: permanent staff as well as casual staff. Most of the time, the permanent staff salaries will be credited to their bank accounts, but for casual staff, some casual payments will be made. Casual payments in the sense some their salaries will be paid in cash, right? If they work, let's say 20 days, at the end of the 20th day, their payment will be made. So there can be a risk, right? He has worked for only 20 days, but you are making a payment for 25 days, or maybe lesser day, 15 days. So in order to avoid that, to prevent that, you need to put an internal control. Maybe just cross-check his attendance before making the payment. Check his attendance, whether he has come 15 days or 20 days or 25 days, make the payment accordingly, right? Simple process, simple act, but prevent so much of errors and frauds. Okay, then the second one is detective control. Once the error or fraud happen, how you can detect that? Best example is CCTV cameras, right? We'll quickly go through these detailed examples. To detect theft of inventories or errors in updating system, carrying out monthly inventory verification and find out reasons for variance between physical balance and system balancing. So let's say the company is having this having a very valuable inventory, like let's say James Gold or something. So maybe at the day end, every day they are taking a physical stock count, right? Today morning we had this much of jewelry, so gold, gems, or whatever the valuable item, and in the evening, so we have sold this much, and this should be the remaining quantity, and this is what we are having, and you are reconciling whether there is a missing piece or not, right? So this is something detective, right? So if let's say someone has stolen a one piece, and you can find it after the reconciliation only, it has already happened, the error or fraud has already happened, understand? The second one, to detect errors in the attendance system or to detect fraudulent behaviors of employees. Performing employee headcount in the factory premises and compare with attendance record. So these example, I don't worry, I will explain in very detail in the business processes. So which is coming under this payroll process, right? When you are having a payroll process, there's a risk of always having the risk of like overpayment or underpayment, right? So there are 100 staff are working, and you are making a salary payment to 150 employees or 110 employees, 10 employees additionally. We call them dummy employees. Actually, physically, there are no such employees, but in the list, there are names. Maybe those names belong to one single person who's doing the fraud, right? Getting all those 10 salaries. So these things we'll discuss in detail. So as an internal control, you can detect this by comparing the attendance sheets with the when they are making their payments, and maybe the physical head counts. You are just counting and reconciling. Understand? Right. Then the third one is to detect unauthorized payment to outsiders. Obviously, the bank reconciliation are one of the best internal controls we are having and commonly used in business organization. So much of errors, frauds are can be identified, but after happen, okay, so it's a detective control, uh, can be identified, and also in long term, a detective control can be converted into a preventive control, because now example, let's say a CCTV camera is acting as a detective control. If something happened, you can look at it and find out who has done it, and gradually when people know that there is a CCTV camera on top of his head, he is like, what's the reaction from the employees? Tend to do a fraud or not? He's not trying to commit a fraud, right? So it's automatically it become a preventive control as well. Simply like similar like bank reconciliation. In the bank reconciliation happens at the month end, it can give you so much of unreconciled items, which can be error or which can be a fraud or which can be a timing difference as well, right? When people know that okay, if I commit this fraud now, but by the time we are preparing the bank reconciliation, obviously it will get caught. So therefore, it's better not to commit the crime. So regularly it acts as a preventive control as well. Okay, so then finally the corrective controls, like I said, controls that are designed and implemented to minimize or eliminate the effect of errors. So the example I use, the entering the same invoice number, just avoiding that, right? So those are corrective controls, right? So this is the matrix I explained. So if you take a internal controls, it can be a financial control as well as it can be a preventive control as well, right? So look at the 9 examples I have given. Preventive financial. Preventive financial is the example is check should be signed by 2 authorities to avoid excessive payment, right? Which is a financial control, obviously, right? If you are if this erroneous payment go out of the company, right? So it will record in your financial statement maybe as a asset or a expense, right? It will be it will record as expense, or it will be recorded as a asset in your financial statement, which is not actually, which is a fraudulent payment. Understand? So obviously, which is a financial control, and also this is a preventive control. Before happening this only, you are implementing the control likewise. So these 9 controls, you just read, like the second one, detective financial, obviously the bank reconciliation, which is a financial control to make sure your financial numbers are reliable, accurate, but you are performing the internal controls after happening whatever the thing, maybe at the month end. So it is a detective control. Understand? So likewise, you can just read these 9 controls which act as a metrics, right? So vertically the objective based controls and horizontally behavior based internal controls. Okay. Right. So before moving to the next part, that is the internal control system, I think there are a few questions. So I'll answer them and move to the second part. Okay, is the same role is done by the internal and the external auditors? Okay, which is a very good question. And as a students who are learning auditing for the first time, obviously you may have this question in your head. What is the difference of this internal auditor and the external auditor? Normally, external auditor, as I explained, is an external party. It's an independent third party which has no relationship with the shareholders, with the management, or with the company, or even with the financial statement. No any relationship, right? He is purely independent. There can be small things which can be mitigated with some safeguards, which we will discuss in detail in future topics. So he is a totally independent party, and his responsibility is to provide opinion on the financial statement, whether it's correct or wrong. Understand? So other than that, he doesn't have any responsibility, right? But when it comes to the internal auditor is an employee of the company, right? He is not an independent third party, right? He is not a third party. He is a party which is appearing maybe in the management, right? He has a relationship with the company, right? So he's not an independent third party, but most of the time he has to act as an independent, has to be independent among the other management personnel, right? So his objective, his responsibility is not to provide opinion on the financial statement, whether the internal operations are like having this reliable, the efficient and effective operations in the business organization, and the reliable financial statement and the compliance requirement, to make sure all these stuff is coming under internal auditor's purview. Internal auditor is a internal employee of the company, a salaried employee of the company, and he is responsible for these operational matters appearing in the business organization. External auditor is the difference. So that's a good question, and which you should clearly identify what are the roles of the internal auditor and the external auditor. Are there any questions? So still I didn't, okay. You didn't receive the last class presentation. I think AAT will send you. Yeah. Okay. Okay, that's it. So I'll move to the next part of the topic, that is the internal control system. If you have any question, just keep sending. I'll complete this part and answer your questions. So guys, now this is also very important. Let's say we'll assume a company which doesn't have a single internal control, right? So there are so much of errors happening, frauds happening, right? So there's a company like that, and suddenly you realize that having a good business process and internal control is a solution for this, right? But that is the reason, that is the solution for this particular frauds and errors and these inefficiencies in the business organization. But you can't implement an internal control and a good business process overnight. Understand? So it's not a 1 or 2 day task, it's a process, right? uh, First of all, you need to have a good environment, right? The environment to communicate employees, this is something happening, right? So otherwise, let's say a simple example, an employee is working as a cashier. Suddenly tomorrow morning when he is coming to the work, there's a CCTV camera on top of his head, right? Which is a maybe internal control. So what will happen to that employees, his motivation level? So the company, so I am working so hard, so I have never committed a crime, I have never done an error, but still the company is not believing on me, company is not trusting me. So as a result, they have put a CCTV camera. So you can't do it like that. It's just, it should be a very smooth process, and it should be a very formal system. You have to do it in a very systematic way to implement internal controls in the business organization, rather than just implementing one internal control which will not be successful at all, right? So let's say that particular employees work will be monitored by CCTV. He or her, like his performance will get affected with the motivation level, and he is not a happy employee at the end of the day, because it's not that a CCTV is implemented on top of his head, it's not communicated to him properly. Why a CCTV coming to the picture? Understand? So that's what we are discussing under this internal control systems, right? So it should be a very systematic, very formal way of implementing the internal control to the business process, business organization. Otherwise, this will not be successful for sure. Understand? So this particular process has 5 steps, 5 straightforward steps. If you can follow one by one, step by step, you can have a very sound internal control system in a business organization. Okay, so we'll take these 5 steps. First one is control environment, then the risk assessment, then the activities, then the information and communication, finally the monitoring. So by the meaning of the words, you can understand, before implementing the internal control, what you need to do first, have the proper environment. First of all, you need to communicate to the employees that there are so much of errors happening in this organization, there are so much of frauds happening in this business organization. As a result, the profitability of the company has going down day by day, right? So if we just implement some set of internal controls, we'll have a very well controlled environment in this business organization. As a result, we can increase our profit, so you will get that profit as a bonus, so salary increment in future, by avoiding all these frauds and errors. So likewise, you need to communicate to the employees and create a culture within the business organization, and simply you need to make the clear the environment of the business organization before implementing the internal control. Simple as that. And then once you created the environment, once you prepared the environment and the culture, and communicate with the staff, right? So then the second one is the risk assessment. Now you need to identify, okay, where the fraud risk or the error risk is there. Where can a fraud happen? Where can error happen? Right? Maybe let's say, okay, inventory, our stores, there can be the frauds, right? So therefore, we'll prioritize our inventory, our stores premises. We'll input our will cover internal controls to the stores first, right? You are assessing risk where it should get prioritized, and simply implement the internal control there. Then the third one, internal control activities, right? Okay, now you have created the environment, you have identified where the internal controls required, and as a third process, you identified, okay, now what should be the control whether we should put a CCTV camera there, or whether we should put a security guard there with the access control, or maybe some bin card system to recognize inventories properly, or some maybe some other controls. Likewise, what is the control, right? Then the fourth one is the information and communication. Here, don't get mixed up with the communication I explained in the first step, which is you are creating a culture. You are communicating the importance of a internal control system to the employees. Here, as the fourth step, it's information and communication means once you implement the internal control, now you need to tell the employee that there is an internal control in this area. Understand? Otherwise, people don't know, they don't follow. You can't blame the people at the end of the day. Simply, right? Okay, you have put a CCTV camera to the stores, right? You have to inform the employees saying that there are CCTV cameras. Then people also will get ready. Employees also will get ready with that internal control. Okay. Then the finally monitoring is the very important part. Sometimes you have implemented the internal control. The CCTVs are there, but it's not working properly. It's not efficient. Whether you have put the CCTV camera not to the right point, maybe to some other point, it has to be replaced with some other point. So that's why the monitoring is also required continuously to make sure you are having a successful internal control system, right? Okay, so each of these 5 steps, I think by the meaning of the word you can identify. First, you need to create the culture, create the environment, and communicate to the employee the importance of the internal controls. Then identify where internal controls should be implemented. Third one, what are the internal controls you need to implement? Then, as a fourth step, inform your staff, employees that these internal controls are implemented. Finally, monitor it, whether it's successful or not. Simple. Right. So we will discuss one by one these environment, these steps. First one is environment. So these are the points you need to make sure. Communication and enforcement of integrity and ethical values, right? So this is how you need to create this culture, right? Rather than suddenly go to the employees and without saying, okay, there are so much of errors or frauds happening in this organization, so therefore we decided to put internal control. You can't say like that. So if you say like that, there can be some negative impact to the motivation levels of the employees, right? So it will be negatively impacted to their performance. So therefore, you have to communicate and create that culture with the importance of having a controlled environment. So like by way of communicating it with the importance of the integrity and ethical values, right? So then only you can create that culture. So this company is a place where this company is like totally free from frauds. Like people don't do frauds here. That's the culture we have created, right? The ethical values, right? Okay, our set of values are integrity, right? Likewise, you can communicate to the employees simply the implanting the significance and the importance of having an ethical environment in the business organization. Then people automatically not trying to commit any frauds or errors, and you can easily implement internal controls there, right? Understand? Then the second one is commitment to competence in the participation by those charged with governance. So that's also very important. Sometimes in business organization, the internal controls are there, but only for the below level employees. The managerial employees are not following those rules. Right? It cannot be the case, right? It should be set by example, right? Okay, CCTV cameras are everywhere, and even in the CEO's room, there's a CCTV camera. And it's very transparent, very visible. Understand? Likewise, it has to be equal to all the parties. Management philosophy and operating cycle. So obviously management philosophy is very important. Then the organization structure. You guys know that there are 2 types of organization structures, the narrow and the wide, right? So you can see that under CEO, there are maybe 5 or 6 corporate heads. Under each corporate head, there are like 2-3 senior managers. Each senior manager is having another 2 managers, then assistant manager. Likewise, it's very narrow and very clearly defined organization structures. In such structures, implementing internal control is very easy. Okay, the hierarchy is clearly defined. Okay, so one person commit an error of fraud, there's a clearly defined superior on top of him, and he can identify it, and even another superior on top of that superior. Understand? So it's very easy if you're having a very narrow organization structure. But at the same time, there are some organizations which has very wide organization structure. Simply the CEO is there. Under CEO, there are like 25 employees are working. Okay, directly reporting to the CEO, which is very wide. So if one employee is committing a fraud or error, there is no one to look up. The CEO can't look at all the single functions done by these 25 people. So in such environment, it's very difficult to implement internal control. Understand, right? So that's why the organization structure also should be prepared according to the internal controls you're going to implement. Then the assignment of authority of responsibility, which is coming with this hierarchy. Then the human resource policies and practices. That's how you should communicate all these things, right? So with that, we'll come to the second part, the risk assessment. Simply, you need to find out where these internal controls should be implemented, right? What are the risky areas, right? So maybe you can't establish or you can't implement a set of CCTV cameras where nobody works, right? In an ideal place, no point. That's why you need to identify, okay, where it should come, right? So these are the points you need to understand. Identifies business risk relevant to the preparation of financial statement in accordance with the entity applicable reporting framework. So identification of business risk, very important, where a risk can happen. Then estimate their significance. Sometimes a risk may be there is a risk of storing something, right? But the significance is very immaterial. Understand? So in such the best example, let's say there's a cashier, where is petty cash cashier, maybe she's handling just a 5,000 rupee petty cash flow. So in order to, like, the maximum fraud or error she can do is just 5,000 rupees, right? But you have implement a CCTV system, maybe like the value of the CCTV camera is more than 1 million, right? That's why. So you need to estimate the significance as well. Likewise, then assess the likelihood of the occurrence. Okay, let's say the cashier, there is a risk. If a risk happen, the significance also, let's say high. Let's say she's handling maybe 10-15 million cash per day, right? If a fraud happen, the significance is also high, but the likelihood is high or low. You need to realize that as well. Maybe in your history it has never done, but history doesn't say that in future also it will continue. There will always be a risk of having a fraud, but you need to estimate the likelihood of the occurrence as well before moving for an internal control. Then decide upon actions to respond and manage them and the results therefore. So you need to identify, okay, where it should where the risk is having and what to prioritize first, what are the response managing techniques, all these things you need to decide. The third step is the control activities, which is also very important. There are like several activities, right? Simply all these internal controls, if you take as an activity, can be divided into these 7 segments. These are like simply types of internal control, and don't mix up with your internal controls classifications. Okay, preventive, detective, not like that. So what type of activity you can perform as internal control? The first one is a very important one, segregation of duties. Segregate your duties as much as possible. Let's say in a business organization, there is an employee who is the one who is ordering goods and receiving goods, recording in the books, right, and distributing those goods. And one man is handling so much of duties and tasks of the business organization. The possibility of having an error or committing a fraud is really, really high. Why? He is handling the next step as well. He can hide it. If he has done a fraud or error, he can hide it because he is the one handling the entire process. So therefore, avoid those frauds and errors. You can divide the work piece into several as much as possible and allocating among several person. Now there's not only one people, there are three people are there. If one person did a mistake, the second one can identify that because it's the same process. So segregation with BTS is that very important activity. Then the physical controls uh, like this what do you call this, access controls, right? CCT, those are physical controls. Then the authorizations and approvals, most of the work done by employees should be approved by another layer, right? Then the management control means the control used by the management. Actually, there are several techniques. So one example could be a budget, right? So you guys know that in most of the business organizations, annual budget is prepared. So budgeted revenue, budgeted expenses likewise. Now let's say now this budget control is having only among the managerial people, right? It's not coming to the all the employees. Let's say we'll take a small example salary expense of the company. Now the company has prepared a budget. Okay, for the next year our salary expense is like this. For normally monthly, this is our salary, right? So every month they are having the budget, then every month they are comparing the actual salary expense with the budget, monthly budget. In particular month, suddenly this salary actual expense increase the budget, right? Now that's a triggering point, that's a red light to the management. Okay, something has happened in the salary, understand? So then they can find out what has happened in the salary expense, whether there can be genuine reasons like new recruitments have happened, right? Some genuine reasons also can be there, but it is a good control, good triggering point for the management to identify an error or fraud has happened in the system. Likewise, there are a set of management controls. Then the supervision controls is like I told earlier, in a factory, garment factory, so maybe some other factories, the supervisor can act as among like a for a set of employees, one supervisor is allocated whether the set of people are working properly or whether they are having idle time managed. In the organization controls, like I said, the organization structure, right? Then arithmetic and accounting controls, whether the arithmetical calculation and all these are correct, which is also act as a internal control. So these type of activities you can apply for a apply as an internal control. Right. So these activities have been detailed in the next slide: segregation of duties, physical controls with example. So I'm not going to explain again in detail, so you can have a look and understand. And even in your textbooks, so these activities are well defined, and with the examples you can read. So we'll come to the final step of the internal control system. Finally, the information and communication. Once you are done with the implementation of internal control, you have created the culture, you have identified where the controls required, and then you have identified the activities. And as the not the final, sorry, fourth activity is you have to communicate it to the employees. Otherwise, people don't know that there's a control like this, right? So without informing the employees that a control is implemented, you can't expect them to follow the rules, right? Therefore, you need to communicate by way of different ways: initiate, record, process, and report transactions, right? So simply this the process documents. Okay, this is how you need to do this. Everything is documented and upload to the company intranet, right? So if someone is participating in a one business process, he can refer to the relevant business process, the process document, which clearly says that this is how you need to do that. These internal controls are implemented. Then maintain accountability for asset, liability, and equity, right? So allocating employees to different assets, liabilities of the company. If something happened to the asset, or if something some error or fraud happening with the particular asset or liability, there is an accountable person, right? So what has happened? Then resolve incorrect processing of transactions. Same like if there are any incorrect transaction or processes, how to resolve those things. Likewise, all these things can be documented and The simple objective is to give a good understanding, good knowledge on the prevailing internal controls of the organization to the employees, right? Okay, so you can read and understand these are a set of modes how you can transfer the knowledge to the employees, and we'll move to the final step of internal control, that is the monitoring, right? uh, the main objective here, the main objective of monitoring is to make sure the implemented internal control is acting with the intended benefits, right? So you have put a CCTV camera to one particular place, and with some intention, so that particular place can be a high risk area. To avoid error or a fraud, you have implemented the internal control. So obviously, with the internal controls, the frauds and errors happening has to be very minimized. That's the intention. Let's say you have implemented CCTV cameras, but still the errors and frauds are happening. So your intention is not fulfilled, right? So you need to monitor and find out what has happened and to rectify it, right? So likewise, there are a few modes or ways of monitoring, right? So first one, management monitoring of control includes considering whether they are operating as intended, and they are modified as appropriate for changes in conditions, right? So if it's not properly happening, just change it, right? That's what you mean by the monitoring. Then the management reviews of whether bank reconciliation are being prepared on timely basis. Like as I told you, bank reconciliation is a very good financial control, right? And most of the errors and fraud, simply most of the business organizations are now very rarely using physical cash for their transaction. All these transactions happen through a bank current account. So the benefit of having current account means each and every transaction happen in the business organization are recorded in another independent party called bank. Understand? So they are in their system, their records also, all the transaction done by you is recorded. So which is a very good point, right? So you can reconcile the transaction you recorded in your books and the same set of transaction recorded in the bank's book, and you can compare and find out something is missing, right? If something's missing, you need to find out what's the reason, and that's what you mean by the bank reconciliation. So it is a very good point, and as a monitoring tool also you can use that, whether it's happening accurately or not. Then the internal auditor's evaluation of sales personnel compliance with the entity's policies on terms of the sales contract, right? So as I told you, as one student has raised the question, the difference between internal audit and external auditor. So all these internal controls are coming under the purview of internal auditor. Understand? Like he may be the responsible party for all these implementation of internal control. The responsibilities with the management. The management assigned personnel to have a proper internal control system may be the internal auditor, right? His evaluation, all these things are coming under this. So a legal department oversight compliance in the entity also can be considered as a good monitoring tool, right? So with that, we'll come to the final part of the session, that is the inherent limitations of internal control. So before moving to the internal controls, I'll explain the limitations first, then I will quickly summarize what we have discussed under the topic, right? In the very first slide, I told you that there are two important points coming under this internal control. First one is the management is responsible. It's not the external auditor, right? It's the management who is responsible for the internal controls. The second box is it's usually provides a reasonable assurance. It's not a 100% perfect absolute certification. Understand? So while by having a CCTV camera, you can't ensure that no frauds or errors are happening, right? By signing two people in a check, right? Check payment doesn't mean that no fraudulent payments are happening in a business organization. Still, it can happen. So that's why it is a reasonable assurance. Understand? So why we call it a reasonable assurance? Because there are so much of inherent limitations of internal controls, which is also very important, right? First one is the controls may not be well designed, right? So maybe you have identified the business risk which should be addressed with the internal control, but that particular internal control is not well designed. It's not the suitable internal control. Understand? Like as an example, let's say there is a risk of duplicating invoices, right? So for such risk, the internal control should be like the system should be recognized whether there are any duplicated invoice numbers. Automated serial number should be maintained in invoices, or maybe payment vouchers. So that should be the internal control, right? But you are designing something else as internal control. So maybe having some physical controls, only authorized person can access to the accounts department. That's the internal controls to avoid a business risk of duplicating invoices. Is not matching at all, right? So likewise, the control is not well designed. That can happen in a business organization. Understand? The second one is the controls may not be implemented as required. That means you have recognized, say there's a cashier is there, on top of his head there's a CCTV camera. The correct control has been identified, but which is not implemented properly, right? So that CCTV camera cannot capture the full actions done by the cashier, maybe a part of the cashier, only like the drawer is not appearing in the CCTV camera. Likewise, the right control but not implemented efficiently. Okay, and the third one is continuous changes in operational risk as a result of the pre-designed controls may fail to address new risk. As you guys know that the entire world is changing, business processes are changing, right? So parallelly, you need to change your internal controls as well, right? If you are not changing your internal controls, then that's also a limitation. The best example is, we'll say this, in order to avoid fraudulent payment, two parties are signing the checks, right? And you guys know that in the business environment, the concept of using this paper check leaves is like very happening at the moment in a very reducing trend. People are not more into using trend. People are very comfortable with online bank transfers, right? This mobile app. Now most of the business companies are using internet banking. If they need to make a payment to the supplier, they are doing it on the internet banking rather than without writing a check. So the control is there for the check. There's no controls for the internal, like internet fund transfer to the supplier. Then obviously, which is not successful, right? If two authorities are signing the check, the same control should be applicable to the online payment as well. Like the payment should approved by two authorities in the system to make the final fund transfer to the supplier's account. Understand? So likewise, the changes also addressed with the internal controls. Otherwise, it will not be successful at all. Okay. And the fourth one is cost of designing and implementing a control does not justify the benefit delivered. Like I explained earlier, a petty cash employee who is handling the petty cash is having a 5,000 petty cash float. And in order to avoid any frauds, a very sophisticated high-tech CCTV camera system is implemented. Right, the maximum frauds he can do is just 5,000 rupees, but the CCTV camera system is maybe 10-15 millions. So you can't justify the benefit and the cost of internal controls. That's also a limitation. Then poor risk awareness culture within the organization. Like I told you, this should come with the environment. When you are communicating and implementing or establishing a well-controlled environment in the business organization, you have not done the communication part properly. As a result, employees are with a very minimum knowledge on the risk. Like people can see only the internal control is there, but the people can't see why the internal control has been implemented, because they don't see the business risk. Sometimes the business risk is visible only to the managerial people, right? The managerial employees. So they need to communicate to the employees, there is a risk like that. That is why you are doing that. That's why you are preparing the bank reconciliation, right? If the people who are preparing the bank reconciliation can't identify the business risk behind that, his contribution to preparation of bank reconciliation cannot be 100%. He might think that, okay, this is just a small work fees I am doing every month, but no point, no one's reviewing, right? There's nothing has happened so far, right? He may tend to think like that. So therefore, a good risk awareness has to be given to each employees with the internal controls. Otherwise, people tend to blindly follow the internal controls, which will not successful at all. Then finally, not finally, actually, the very common one, the human errors, right? So all are human beings. Of course, error can happen. Duplication of 1,000 can be written as 10,000, right? So zeros, ones and zeros can be mixed up. So likewise, some human errors can be happen as a result. Also, we can't say that the 100%, the internal controls cannot remove or eliminate frauds and errors 100%. Then finally, the non-routine transactions are not covered. So the best example is, let's say the company is having a good business process to purchase fixed assets, right? Good processes established and good internal controls is also there, right? So they need to call for quotations, then they need to select a suitable supplier. Likewise, the process and the controls are there, right? Fixes for fixed asset, and suddenly they are purchasing maybe, let's say, a land. Maybe that's a one-time transaction for the entire lifetime of the business organization. Understand? But that one-time transaction of purchasing a land is not addressed or covered through the established processes and internal control. What are the procedures to be followed when you are purchasing a land is not described. Why? You are not purchasing lands every day unless you are a land buying and selling land company, right? So it's like a one-off ad hoc transaction happen. So for such transactions, uh, business processes and controls are not uh, address, right? So that can be very commonly happen in business organization. Another example, let's say you are selling a fixed asset, right? So you have all the policies and procedures to purchase a fixed asset, as well as like selling. Your sales process also may be addressed with a good process and internal controls. But suddenly you decided to sell motor vehicle used by you. Now what are the procedures? Whether you are to call for the quotation, so whether you go with the tender process, or whether it's auction, or whether you are putting a newspaper advertisement. So nothing has been defined in anywhere, right? So that can happen for non-routine transactions like that. So internal controls may not sufficient to address those transactions. So with that, we can conclude the first part of our chapter 3. So I'll quickly give a brief summary. Internal control and business processes are very important. That's where you can avoid frauds and errors, right? So frauds and errors are the reasons to have a misstated financial statement. So in order to have a uh, like correct financial statements, right? Whether to make your financial statements are free from material misstatement, what you need to make sure is to avoid risk and errors and fraud. So in order to avoid errors and frauds, what you need to make sure to have a proper business processes and internal control. So in these two parts, business processes and internal controls. So today we discuss internal controls. Business processes will be discussed in the next week. So under internal controls, two main important points. First one is the management is responsible. Second one is this is only gives a reasonable assurance. Why it can't give a 100% assurance is these are the reasons we just discussed, limitations, right? And these internal controls can be divided into two major parts based on their objective and based on their behavior. So based on the objective, it's the to have a reliable financial statements, have efficient operations, and complied rules and regulations. So the behavior is to prevent error or fraud, to detect an error of fraud, or correct an error of fraud. Likewise, there can be 9 internal controls, 6 types as a matrix. It comes as a 9 internal controls you can implement in a business organization. So as I told, these internal controls cannot be implemented in a one night in a business organization. It cannot be done overnight, right? It's a very systematic process the 5 steps process. The first step is you need to create an internal culture, environment, right, in the business organization first. Then you need to identify where are the risky areas. We call it risk assessment. Third one, control activities. You need to determine, okay, what are the internal controls you're going to implement. Fourth one, communication to the employees. You need to inform the employees these are the internal controls. And finally, monitoring. So so that's it about the syllabus coming under internal controls. So very rarely, if I'm talking about the exam focus, very rarely they have tested these areas as a theoretical concepts in the part A or B of your exam paper, as a like what are the steps of the internal control system. Likewise, those type of questions are very rarely they have tested. Most of the time, this internal control part is combined with the business processes and come as a 25 marks, one big case study type question. So once we discuss the business processes next week, we will discuss how the exam paper is also coming in this area. So very important, guys. So keep these things in your head. And as I told, this is the starting point, and that agency conflict picture is very important, and where this internal control fits in this picture is very important. So keep that in your head all the time. Likewise, next week we'll meet at the same time and discuss the 5 business processes we are supposed to discuss. That is the payroll process, procurement process, fixed asset process, cash management process, and the inventory process. 5 business processes will be discussed next week. So with that, we'll wind up. So thank you very much.
Thank you very much, Mr. Taranga, and also big thank for the students those who are joining us today. And our next session of this webinar series will be held on tomorrow morning from 10 to 11 in the morning for the student second stage students. So for the subject of business management. So join with us and share this message among your friends. So stay home safely and study well. Have a nice day. Thank you very much.